We are now seeing a lot of data that shows that the housing market is finally looking like it's going to roll over here. And so two questions for you. How bad do you think this national rollover could be? And then secondly, how bad will the negative wealth effect that it engenders impact this recession we're talking about, right? Because as consumers feel less wealthy, they spend less, right? So is there, some are losing money in their retirement accounts, some are losing their jobs, but a bunch of them are seeing their housing prices go down. Is that going to lead to, accelerate the demand destruction that just brings corporate margins down even further because folks just aren't buying stuff?
So 1 in 5 houses are owned by an institutional investor. So there's a lot of inventory to yet pop up as home prices stop going up. It's a wonderful, it's a wonderful dynamic when you buy up huge tracts of single family homes and then you say, oh, the poor middle class can't afford a home. I bought them a home and I'm going to rent it to them. And then my home goes up in price. So, balance sheet looks great. And I have a great cash flow as I raise their rents. That's wonderful. Wall Street, I hate, did I ever tell you how much I hate Wall Street? I abhor them. In fact, I have a picture in my office of someone that drew me 3 little pigs. Just disgusting that you buy single family homes. I'm talking about, some, I won't name their names. How about that? But you know who they are.
I'm going to name a few. So anyways,
Blackstone, maybe Blackstone could be one of them. and then you rent it to people as and then you couch it as you're doing them a favor. So you're going to be selling those properties. They're going to be dumping them as they're no longer profitable and hurting your balance sheet. The inventory, as I mentioned, is rate of change basis is absolutely skyrocketing. I think home prices could drop 20%. They dropped 33% in the global financial crisis. But the underwriting standards were worse back then than they are now. Right. So I'm just saying, and maybe because of mollifying effects, maybe ameliorated to only a 20% decline. A 20% decline, you will feel it in your pocketbook, especially since a great number of the homes with a mortgage right now have been purchased in the last few years.
Right. So their equity is gone.
Their equity is gone. Equity is gone. That's definitely. And by the way, the consumer, and people say consumer is so strong. If the consumer is so strong, why is credit card debt surging? I think this month was the second month, 40 billion this month. That's the second most in history increase in debt. The first was a few months ago at 47 billion. So, if the consumer is so strong, why are there, I very strongly believe that they're relying on debt just to maintain their standard of living. They're forced to rely on debt to maintain their standard of living. And credit card rates are tied to prime lending rates, just like adjustable rate mortgage.
Which are going up.
They're going up significantly. So when people say, what is priced in? Is QT priced in? No. Are the Fed rate hikes priced in? Not at all. A bear market bounce, which is fooling a lot of people to go long the Reddit board stocks, the most, the Cathy Wood stocks of the world. The stocks that aren't going to be around in a couple of years. Those are the stocks, probably not going to be around in a few years. Those are the stocks that they're migrating to. I'd be very cautious chasing bear market bounces. I'd rather be unchanged or down 1 or 2% on the year than chase the top of a bear market bounce, which is going to just careen to lower lows in the next few months. And guess what? You can find me. Have me back on. Have me talk about why I was right or even why I was wrong.
If you enjoyed this video clip, click here to watch another one you should like.